G'day mates! This past weekend, the global market's smart money was holding its breath, glued to a heavily guarded room in Pakistan. Top-level US and Iranian officials were locked in for a staggering 21 hours of intense, closed-door talks. Think about that for a second. 21 hours of non-stop, high-pressure psychological warfare with no sleep. This was the most significant direct contact between these two rivals since the 1917 Islamic Revolution and the total break in ties. The US side was led personally by Vice President Vance, while Iran sent their Speaker of Parliament, Kalibaf. Investors were punting hard on a grand finale, where both sides would finally shake hands and announce a total ceasefire. But instead, the world was hit with a massive bombshell. The talks collapsed completely, ending with absolutely no result. When Monday morning rolled around, global financial markets went absolutely off the rails, like a grenade had been tossed into the exchange. Brent crude took the first hit, jumping nearly 10% on pure adrenaline and smashing back through the $100 a barrel mark. With oil going gangbusters, the US dollar index surged back above 99, putting immense pressure on everything else. As for gold, it followed the same war logic. It tanked as tensions escalated, dropping below $4,700 and hitting a low of $4,640. However, while USD-priced gold is under the pump, we need to look at our own backyards. The weak Aussie dollar is actually acting as a natural buffer for us down under. During those 21 hours, what exactly were the three deal breakers that caused both sides to walk away, despite the risk of a total maritime blockade? Why did gold, the ultimate safe haven, actually collapse right as Middle Eastern tensions hit a boiling point? Is this a total collapse of gold's fundamentals, or is it just a bloody case of liquidity slaughter? Today, we're peeling back the fog to reveal what really happened behind those closed doors. We'll also look at why the World Gold Council is telling everyone to keep their cool, claiming the fundamentals are still rock solid. Just a quick heads up before we get started. I'm a fellow trader, not a licensed advisor, so do your own research before dropping any cash. Now, let's get into it. First, we have to look at how this failure actually played out on the ground. Market expectations were sky high because everyone figured that if the US Vice President showed up for 21 hours, a deal was inevitable. But when Vice President Vance faced the media after the session, his expression was cold and stone-faced. He stated firmly that the US had set its clear, red lines and a final best offer, but Iran simply refused to accept the terms. This single statement wiped out the peace premium, that extra risk pricing that had been fading on hopes of a ceasefire. Suddenly, the dream of the Strait of Hormuz reopening and oil dropping back to $80 was dead in the water. In financial terms, this is a classic case of bullish expectations failing, leading to a violent repricing of global assets. You might be wondering, what on earth were they arguing about for 21 straight hours that they couldn't sign a single piece of paper? According to insiders leaked to the New York Times, these two sides weren't even eating at the same table, metaphorically speaking. Essentially, the US wanted a massive future promise from Iran, while Iran was demanding a massive post-war package up front. The friction centered on three absolute dead spots, where neither side was willing to give an inch of ground. The first dead spot is the control of the Strait of Hormuz, the world's most vital energy artery. This narrow waterway, only 21 nautical miles wide at its tightest point, carries a third of the world's seaborne oil and a massive amount of LNG. Iran was incredibly aggressive, demanding 100% control and the right to charge transit fees to international commercial ships. The US government, holding on to global maritime hegemony, flatly rejected this, insisting the strait is international water where no nation can set up a toll booth. This is a classic Clash of the Titans scenario where neither side can back down without losing face and strategic power. The second dead spot is the nuclear issue, which is a massive headache for global security. The US is determined to solve this once and for all, demanding Iran hand over its stockpile of roughly 900 pounds of near-weapons-grade enriched uranium. For Iran, this uranium is their ultimate insurance policy and the only card that makes the West hesitate to strike harder. Iran only offered to pause development while keeping their stock, a counter-offer the US binned immediately, citing a lack of sincerity. The third dead spot is the $27 billion in frozen assets and war reparations that Iran is desperate to get back. Iran wants the US to pay for the damage from airstrikes over the last 6 weeks and immediately unfreeze oil revenues stuck in banks from Luxembourg to Japan. The US refused point blank, fearing the cash would be funneled directly into regional militias or restarting the nuclear program. Because these points involve core national interests, this wasn't a peace talk as much as it was a 1-hour session of mutual extreme pressure. However, there's a hidden silver lining. The fact that they could sit in a room for 21 hours without walking out suggests both sides actually want to end the war. They just can't agree on how to split the bill yet. What happened next was pure madness. After the talks failed, the US Central Command issued a brutal statement. They are imposing a total blockade on all Iranian ports. This covers every port in the Persian Gulf and the Gulf of Oman, and they warned that any ship entering or leaving would be intercepted. This creates a double stranglehold on the Strait of Hormuz, Iran threatening tolls on one side and the US blockading the ports on the other. Bloomberg shipping data shows that as soon as the news broke, 2 massive supertankers headed for the Gulf did an immediate U-turn. In the eyes of ship owners and insurers, the risk hasn't gone away. It's actually spiked to a whole new level. So, if things are this tense, why the hell did safe haven king gold collapse? If you've been following this channel, you'll know the bloody logic at play here. The first blow to gold is high oil prices, jacking up inflation and strengthening the US dollar. Think about the chain reaction. Failed talks lead to a blockade, which sends oil past $100. Oil is the lifeblood of the global economy. When it goes up, transport, chemicals, and even grocery prices follow suit. This puts the US Fed in an impossible corner. They were planning on cutting rates, but $100 oil makes inflation catch fire again. This has massive knock-on effects for us in Australia too. If the Fed is trapped and forced to keep rates high, or even hike them again, the RBA will have zero room to move on our own interest rates. If the RBA stays hawkish, it's an absolute nightmare for Aussie families who just fell off the fixed rate cliff and are struggling with massive mortgage stress. Capital flows back to the US for safety, pushing the greenback up and gold, which is priced in USD, down. The second blow is even more brutal, the liquidity slaughter. When oil spikes and inflation fears drive interest rates higher, every risky asset, like stocks and high-yield bonds, faces a terrifying stress test. When these assets start tanking, big hedge funds and institutions face the monster of the trading world, the margin call. If you've got no cash and you can't sell your sinking stocks, you're forced to sell your gold, the most liquid asset in your safe, just to stay afloat. Gold becomes the ultimate ATM for the entire financial system. People aren't selling gold because they don't like it. They're selling it because they are desperate for USD cash. Have you ever been on the receiving end of a death call from a broker, forced to cut a winning position just to cover a hole? Let us know your horror stories in the comments. When you see oil smashing past $100, are you more worried about getting smashed at the checkout at Coles next time? Or are you dreading that AGL power bill and $2.20 unleaded petrol emptying your wallet? The pain you're feeling is showing up in the numbers too. The latest US CPI report was a shocker, with monthly inflation jumping 0.9%, the biggest monthly spike since June 2020. Gasoline prices alone accounted for nearly 3/4 of that monthly jump. This perfectly mirrors our situation in Australia, where our CPI remains stubbornly stuck around 3.8%, way above the RBA's comfort zone. The real fear is the secondary transmission effect, coming in April and May. High fuel costs mean Delta Airlines is already warning about ticket prices, and road freight will push up every item on the supermarket shelf. This is a dead end for the Fed, and the RBA, the window for cutting interest rates, is slamming shut. This strong dollar expectation will continue to crush gold bulls like a mountain. While things look grim, the World Gold Council report is providing some top-tier psychological massage for long-term holders. They admit that gold's 12% crash in March was its worst monthly performance since 2013. But they are firm. This is not a collapse of gold's fundamentals, but a deleveraging event. First, as we mentioned, it's the cross-asset, selling by investors looking for cash. Second, it's the CTA strategies, the algorithmic trading models that follow the math without emotion. When gold broke below the 5-0-day and 5-5-day moving averages, these bots automatically triggered massive sell orders. Interestingly, the WGC also pointed to central banks like Turkey, who used 50 tons of gold as collateral in swap deals. While retail investors panicked seeing 50 tons of gold hit the market, it actually proves gold's immense value as the world's ultimate collateral. Central banks haven't stopped their long-term strategy of stacking gold. The WGC report reveals a fascinating split in money flows. While $12 billion bled out of gold ETFs in March, nearly all of that came from North America and Europe. While the big Western institutions were dumping for liquidity, Asian markets actually saw an inflow of $1.9 billion. This shows a West is dark, East is bright scenario. When Wall Street is forced to deleverage, local Aussie buyers and savvy mum and dad investors running their own SMSFs are holding firm. They are busy absorbing the cheap chips that the Western institutions are tossing out. If you look at the physical gold bar sales at the Perth Mint lately, you'll see the smart money isn't sweating. Instead of catching falling knives with high-risk tech stocks, smart investors are looking at local gold miners on the ASX. The long-term outlook remains strong because gold's core pillars, inflation hedging and de-dollarization, are only getting stronger. But WGC warns we must keep an eye on oil. If it stays over $100, we could see more liquidity tests. If you had a few $100,000 sitting in cash right now, would you buy the dip like a savvy investor or stay on the sidelines? Let us know your move in the comments. Wrapping up, gold is under short-term pressure but remains a strong equals buy for the long term. The key variable for Monday is whether the market prices in the permanent blockade of the Strait. If that becomes the base case, oil stays high, the dollar stays strong, and gold stays an unlucky ATM. But looking long-term, the pillars of this gold bull market are sturdier than ever. US national debt has blown past a staggering $39 trillion. This scale of expansion is simply unsustainable. Failed talks like these only push the global south and non-US economies harder toward de-dollarization. Gold remains the only sovereign credit asset with zero counterparty risk, and its historical value is only becoming more obvious. Short-term liquidity slaughters are often the best golden pits for long-term investors. I have to hammer home this risk warning one more time because it's a do-or-die moment for trading discipline. Market volatility is extreme right now, and swings of $50 to $100 a day could become the new normal. Never ever go all in or use high leverage just because you're bullish long-term. Keep a clear stop loss. Only punt with money you can afford to lose, because this market will chew you up if you aren't disciplined. If your heart can't handle a ride on the Luna Park roller coaster in Sydney, then keep your powder dry and sit on the sidelines. Remember, it's better to miss a move than to blow up your account. Only those who protect their capital get to see the rainbow. That's all for today's deep dive on Gold Jumper. If this helped you make sense of the macro chaos, please smash that like button. Just a quick heads up, legends. I'm a trader, not a licensed advisor, so do your own research before dropping any cash. Drop your thoughts in the comments below, and don't forget to like this video and subscribe to the channel for more market madness. Will gold reverse or keep digging deeper? Leave your God prediction in the comments. Cheers for watching, stay safe out there in the markets, and I'll catch you in the next one.